All right, folks, in the last two videos, I talked about the limit order and I talked about a market order. Now I'm going to talk about a stop order, and then we'll put all of these together. So, what is a stop order? A stop order is the opposite. It's the opposite of a limit order. It's that simple. Let me explain. A limit order, as I showed you, let's say something is trading at $65 a share and you want to buy it at $64.50, right? That's a limit order. But let's say something is trading at 65 and you want to buy it when it reaches 66. Or let's say something is trading at 66 and you want to buy it when it reaches 66.50. All right? That's a stop order. So whenever you want to buy above current price, or you want to sell below if my third grade teacher was here, she would probably kill me for writing so bad, but it is what it is, folks. It's one of those things. They say doctors and lawyers can't write. Well, I went to law school for 4 years. Go figure. So anyway, a limit order is when you're buying below, you're buying cheaper. A stop order is when you want to buy for more. You want to see a breakthrough in price. You want to see price lead. You don't want to get a discount. You want to pay more. So if something's trading at 100 and you want to see if it breaks 100 and goes higher, to 101, for example. Let's say, and here's when you would do this. A lot of times we would see price congest like this and go for a little while, for a few months, and then come back. And traders want to watch that level, and let's say that level's at $100 a share. So they would put an order right here at 101. And when price hits that level, the order gets executed, okay? All right, so it's a trigger. You would use a stop for a trigger. You're spending more than the current price because you want to see that momentum hit something. So your order's here and price is moving, and then pow, it hits it and it continues moving. So the price is 101, that's your stop order, but price is currently at 100. And if you're selling, it's the same thing. Let's say let's say the price has been going from $200 a share to 101, and you want to break it. You want to see it break 100. So you would place a stop order at $99, okay? And then if it goes from 200 to 101 and to 100, and if it finally breaks 99, that's when you get your fill. So you get your fill on a limit order when you're buying cheaper or selling for pricier, but you get filled on a stop order when you're buying for more than it currently costs or you're selling for less than it currently costs. So to give you another one of my brilliant visual analysis. So again, let's say you're trading Amazon, okay? And let's say Amazon, I misspelled Amazon. Let's say Amazon is trading at $1,840 a share, okay? And let's say you want to buy Amazon when it reaches $1,850, okay? That's a buy stop. And let's say you want to sell Amazon when it goes down to $1,800. All right, you believe it's going down, but you don't want to take that chance till it hits 1,800. If you place an order to sell at 1,800, that's a stop order. So whenever your order is to buy above the current price or sell below the current price, that's a stop order. And again, what's the upside of a stop order? The upside of a stop order is you don't get filled till something moves in your direction, so you have directional momentum. The downside is you're obviously paying for more. So you're paying for more than what it currently costs. But you're doing that for a reason. And B, the biggest factor is once price hits your limit price, it becomes a market order. So if there's a liquidity issue, you're going to be subject to that. So again, I wouldn't place stop orders on assets that have liquidity issues. I would only use market orders and limit orders. If you want to place a stop order, use an alert. Put an alert, a price alert on your platform. So if you want to be alerted to when it trades at 1850, Amazon again, you would just put an alert there. You would hear an alert, then you would go to your platform and you would place either a market or a limit order. So again, a limit order allows you to buy below the current market price or sell above the current price. A stop order allows you to buy above the current price or sell below the current price. And the biggest upside of a stop order is it won't get hit till momentum moves in your desired direction. The biggest downside is a stop order will turn into a market order. So if there's a liquidity issue, that's going to hurt you. So be careful when you're placing stop orders. And again, you can place stop orders for entry and exit, just like you can a limit order. We don't discriminate, the market doesn't discriminate. So you can place a buy stop or a sell stop. You can place a buy stop to enter the market and a sell stop to protect your position. You can place, if you're shorting, a sell stop to enter the market and a buy stop to protect your position. I recommend you watch these videos a few times so you can get a real clear understanding. But again, buy stops is when you're buying above the current price. Sell stop is when you're selling below the current price. The order turns into a market order before it fills, so liquidity could be an issue. And lastly, you can use stop orders when you're entering a position or when you're exiting a position. Hope that helps. Next video, we're going to talk about combining a limit and a stop order together.